Good afternoon, ladies and gentlemen. We'll start the webinar, 12th webinar of ASBM University. Respected founder and president of ASBM University, Professor Dr. Vishwajit Patnaik, Revered Vice Chancellor of ASBM University, Professor Dr. Kalyan Shankar Rai, respected Pro Vice Chancellor of ASBM University, Dr. Falguni Ranjana, and respected Dean, School of Accountancy, Dr. Hemant Kumar Panda, esteemed panelists, and my dear participants. Welcome you all to the 12th webinar of ASBM University on the topic Trade and Investment, the Post-COVID Scenario. Asian School of Business Management has been established in the year 2006 by the former professor of IIM Lucknow and Indore, Dr. Vishwajit Patnaik, who is popularly known as Lagan Professor. In the year 2019, 27 September, it became the state university. The university
Professor,
regularly...
you are not audible. Hello?
Yes, ma'am.
Professor Sudhanshuji, you are not audible. I can't hear you.
Okay.
Good afternoon. Can you hear me?
Yes, ma'am. Professor Mandal, am I audible?
Yes, both of you are audible completely. Okay, there is no problem.
I think there might be some network issues on your end. Can you please check?
We could hear.
Hello?
Yeah.
We could hear both of you.
Yes, ma'am.
Oh, yeah. I can hear you now. Thank you.
Yes, ma'am, please. Okay.
Yes, continue.
ASBM University regularly conducts faculty development programs, certificate programs, seminar conferences, and webinars. Already we have conducted 3 certificate programs in last 3 months in the areas of research methodology, logistics and supply chain management, and human resource management. 2 more certificate programs will be conducted very soon in the areas of finance and marketing. Let me introduce our 2 esteemed panelists for today's discussion. Our first panelist is Mr. Vishal Shukla. He is the Deputy General Manager, Securities and Exchange Board of India, and is currently the faculty member of National Institute of Securities Market, NISM, Mumbai, which is established by SEBI. Mr. Vishal Shukla, he is an MBA from University Business School, Punjab University, Chandigarh, and Masters in Public Policy from Graduate Research Institute for Policy Studies, Tokyo. Mr. Vishal Shukla has been working with Securities and Exchange Board of India, that is SEBI, since 2002 and is currently posted with NISM as a faculty member in the School for Regulatory Studies and Supervision. While at SEBI, Mr. Shukla has gained invaluable experience in licensing of market intermediaries and conducting inspections, market surveillances, and handling investor grievances. Mr. Vishal Shukla is currently teaching securities market law, and he is avid interest in macroeconomics, financial economics, and aspects related to regulation of financial markets. Today, Mr. Shukla will deliver his talk on the topic regulatory changes and SEBI actions in the post-COVID era. Coming to our second panelist of today's webinar, Dr. Latha S. Chari. He is the Associate Professor, National Institute of Securities Market, NISM, Mumbai. Dr. Latha Chari is a doctorate in finance from BITS Pilani, postgraduate in commerce, and a fellow member of Institute of Cost Accountant of India. She has an experience of about 2 decades in academia and industry. She started her academic career as a fellow with IILM New Delhi. Before joining NISM, Dr. Chari has worked with Institute for Technology and Management and ITM Institute of Financial Markets for more than a decade. She joined ITM as a lecturer and grew up the hierarchy to become the Deputy Director, heading ITM Institute of Financial Markets. During her academic tenure, she has published many papers in reputed national and international journals and conducted MDPs in the areas of financial assets valuation, strategic cost management, trading and operations in equity market, performance evaluation of mutual funds, and the like. Dr. Chari areas of research interest includes strategic cost management, corporate valuations, shareholders value enhancement, and similar studies. She has special interest in establishing finance labs and in design, development and delivery of lab-based course in the areas of banking and financial markets. Coming to today's topic, that is trade and investment, the post-COVID scenario. As we all know, COVID-19 is a dark cloud that has suddenly descended on humanity. But even the darkest cloud have silver linings. Indeed, the Chinese word for crisis, that is Wuzi, which signifies danger as well as opportunity. The Black Death of Europe in the 13th century and pre-19th century cholera epidemics and Spanish flu in pandemic 1918 not only shook societies and economies but also opened new pathways to change. There is little doubt that the COVID-19 crisis will similarly change the world in profound ways, perhaps permanently, but it will also come with opportunity. And all the countries need to be alert to such opportunities so that some good potentially be extracted from so much bad. One of the changes will be re-evaluation of the long and complex value chain that have over last three decades, supported dramatic improvements in manufacturing efficiency and material standard across the world. These value chain, financed enthusiastically by investors in advanced economies, have also allowed China to become the factory of the world. Efficiency and profit-saved investment location decisions, not trail risk or black swan events. Competitiveness prevailed over resilience. To achieve the right balance between the two, investors will scoring the world for locations where strong states have shown themselves capable of managing black swan event effectively. The COVID-19 pandemic has made that tellingly transparent. For foreign investors looking alternative investment locations, that leaves very few countries that have strong government capable of replacing China as an important source of cheap skilled labor. In India and Indonesia should top the list of the candidates. They are large countries located near China. Moreover, India has been unusually effective in dealing with COVID-19 crisis so far. It's important that India is considered to share values and interests that align closely with those of Western democracies. It has impressive entrepreneurial talent, a large internal market, and thriving private enterprises. Its analytic, financial, and management services are world-class. Clearly, India needs a fundamental shift in its attitude towards trade and foreign investments if it is to figure in the emerging post-COVID-19 calculus of foreign investors. In the event it doesn't, it will once again forego an opportunity to benefit from the expected post-COVID tsunami of firms that will choose to relocate away from China. So without wasting time, I just want to continue further discussion. I would like to request our first panelist today, Mr. Vishal Shukla, to address the participants. Sir, please.
Thank you, Professor Nanda. Hope I'm
Yes,
audible. Yeah, thank you. Thanks a lot, Professor Nanda. Good evening, everyone. I'm thankful to ASBM University and Vice Chancellor Dr. Kalyan Shankar Rai, Dr. Bishwajit Patnaik, the founder president, Pro Vice Chancellor Dr. Philangani Niranjana, and Dean Dr. Hemanta Panda, and distinguished faculty members and students. So today I'll be beginning with laying down the regulatory framework which evolved as a result of the COVID-19 crisis. And after I'm over with my presentation of about 15 to 20 minutes, then Madam is going to speak about how the markets performed. So we are going to restrict ourselves to securities market, since we belong to Securities Market Institute, and the aspects that we'll be discussing today would be relating mostly to the securities market. So I have prepared a small presentation, and I'll be sharing that presentation with you. I'll just start presenting myself. Please let me know if my screen is visible to you. I hope now my screen is visible. Hello. Dr. Nanda, is my screen visible now?
Not yet, sir. Not yet, Vishalji.
And just see. Somehow it's taking time.
Yeah, sometimes it takes a few minutes to come on.
Yeah. I think now it will be visible.
Yeah, presentation, yes.
Yeah, it's fine.
Starting to be visible, yeah.
Yeah. We'll be speaking about the regulatory and supervisory response to deal with the impact of COVID-19 scenario. And basically, I'll be restricting myself to the securities market. And if we look at this scenario, it's a very, very serious crisis. And as Professor Nanda mentioned, that it is a serious dark cloud over humanity, and it has had its impact on nearly all the aspects of life, and the commercial aspects notwithstanding, they've also been hit hard. And one important aspect is that the markets, as compared to the real economy, they bottom out very fast. They respond to such crises in a very, very swift manner. Hello.
Sorry to interrupt, sir, but screen is not visible.
It's not. Professor Nanda, my screen is visible or not?
Is the screen visible, but sir, just pin the screen. It's sliding.
So your screen is visible, but I
Yeah.
think it is visible along with the other photographs. So maybe you means people's photographs. Maybe you have to search it out and then choose that and then change your what shall I say display to be able to see.
I'm using the full like the full screen display.
No, that's for the participants.
Yeah.
For me, it's visible and very
Yes, sir, it
nice.
is visible, sir.
Visible.
Yes, sir.
Yeah. So we can easily draw parallels between the crisis caused by the global financial crisis in 2008 and the crisis that has been caused by this COVID-19 global pandemic. If you look at the markets, as I said, that the markets, are responding very swiftly to such crises. So if you look at this comparison between the global financial crisis in 2008 and the crisis that has unfolded in the markets after COVID-19, the markets were, say, at 6287. Nifty was at 6287 on January 8, 2008, and it fell down to 4073 on September 14, 2008, which was the Lehman shock, and it further fell to 2524 on October 27, 2008. So there was a steep drop in the market in a period of 7 to 8 months. Whereas if you see the COVID-19 scenario, the market was at all-time high. Nifty was at an all-time high of 12,362 on January 14, 2020. These are the closing values of Nifty. And it fell to 7610 on March 23, 2020. So the fall here was much steeper. It was much more rapid during the COVID-19 crisis. And it has still not reached the levels of January 2020, but we've come up to 11,300. I think yesterday it was 11,312. So we are trying, to now reach those levels which we had touched in the January of 2020. There's another measure, which we can use to compare the volatility in the markets during these two time phases. So the volatility index of the Indian markets, if you compare for 2008 and for this global pandemic, they are nearly the same. Normally, we have the volatility index. If you go and see the National Stock Exchange website and look at data, normally it is between 18 and 22. Those are the values that you would normally see on most of the days. But during this pandemic, we found values rising about 3 to 3.5 times the normal values, and it rose to about 62. A similar kind of situation was witnessed during the crisis, global financial crisis, when it was hovering around 55 to 60. The values were like the volatility was very, very high in the markets. Now, as a regulator, SEBI has threefold mandate. The threefold mandate that SEBI has is basically the first and foremost mandate is to protect the investors. Then it is to regulate the markets, and thirdly, it is to ensure that the markets the policies are made for the development of the markets. That's the threefold mandate that SEBI works with. Now, from all the financial regulators, there are some regulatory expectations, and these are the regulatory expectations which were discussed in a recent paper by IMF. The source is given at bottom of my slide. So there was this IMF paper. This was the special series on COVID-19. So they had come up with a paper on how the markets, rather the securities market regulators should respond. And it was more of a wish list. And this was before the lockdown had been announced in most of the economies. So the wish list was that the response of the regulator should be proactive, flexible, transparent, and approach to react to the rapidly changing scenario. In addition to that, the regulator should respond, very swiftly to the operational challenges faced by the market participants. So the market participants, because of the health crisis and also because of the lockdown, there was a resource constraint. People were not coming to offices. There was this problem of reduced strength in offices. People were working from home. There was a technology issue. There was an issue related to cyber security. So how would the regulator respond to that? Another aspect was because there was so much of there was not much clarity about how the things would evolve. So there was a lot of indecision, and this resulted in a lot of volatility. So the regulatory response was to how to curb the volatility. And another aspect was because of the volatility and because of the impact on businesses, there was a certain risk of some asset classes not performing well. And there was some, because of non-performance and because of illiquidity, so there could be some problems on the redemptions. So there was a problem in redemptions, and there was some likelihood of default. So how the regulators would respond to this aspect. And another aspect was whatever the steps the regulator is taking, it should be clear in its communication to the stock exchanges, to the market participants, and to the investors. So this was the expectations from the financial regulators as per this paper by IMF. Now, one important aspect, which the regulators were confronting was on volatility. So high volatility is not a very, very desirous situation. It is not a good situation. And market regulators across the world, they view volatility, as something which needs to be addressed. And they have developed tools to address this menace of volatility. So some of the tools are trading halts. So you have the circuit breakers. If the market is say rising or falling below a certain level during the day, so the circuit breakers come into play. If the index movement is below 10% or above 10% or 20%, sorry, 15% or 20%, accordingly the circuit breakers come into play. Then there are security-wise price bands which are imposed. In addition to that, if there is increased volatility, then the regulators also impose increased margins. And the other aspect is that during these periods of volatility, so there are people who would like to speculate and they would like to short sell. So they would like to sell without possessing the stock and then later on buy when the stock is trading at a lower price. So it was very, very important to impose trading restrictions on short selling as well. So, but there is a debate about imposing restriction on short selling. So there are people who say that if you impose the restrictions on short selling, so you are creating illiquidity in the market, and there is also this impact on efficient price discovery. But any such restriction should be for a short duration, and that is what the regulators, with that view only, the regulators imposed these restrictions on short selling. And in Indian markets, so there was this 10% fall in the market indices, and it triggered a market-wide circuit break on March 13, 2020, and the market had stopped for 45 minutes. Madam has done a lot of work in this area. She recently wrote a paper as well on the market-wide circuit breakers. So Madam could, much more in a much more better way, she could enumerate this aspect. In addition to this, the Indian stocks had fallen in wake of the COVID-19 outbreak, and SEBI also imposed restrictions on short selling to stabilize the market and maintain investor confidence. And the margin requirements were also increased. So SEBI came up with a press release on March 20, 2020. And in this press release, SEBI had discussed about the market-wide position limits. So for each of the securities in the derivative segments, so there are position limits imposed so that no one is able to corner the market. So SEBI had come up with the position limits. They had set up the revised position limits. In addition to that, if the position limits were breached, about say it was 95% position limit was reached, then that security was, the derivatives in those security was banned, and the trading in that security was only allowed to offset the already held positions. And there were increase in the margins imposed on the securities. So there was increase in the margin for the non-future and option stocks in the cash market. In addition to that, SEBI had also put some revised position limits, as I've already spoken. And there were some revisions in the price bands of the securities as well. Now, on 24th or 25th of March, we all know that India went into a lockdown. So this had imposed a lot of hardships to which we are all, familiar with. So lockdown brought the economies to a standstill. In certain sectors like airlines, manufacturing, travel and tourism, and small businesses and manufacturing, they suffered very, very adversely because of this lockdown. There were certain sectors which were not so severely impacted. So you had pharmaceuticals, you had retail, you had finance, and you also had the IT sector, which were not so severely impacted by this lockdown. But then the impact can only be assessed by the firms themselves. For an outsider to objectively assess this impact is very, very difficult. So an objective estimate about these losses that the firms and the businesses have suffered is very difficult to make. In addition to that, as I've spoken before, there was this reduced staff strength and working from home. It also produced challenges in form of productivity and cybersecurity. So regulators had to, constantly address these issues as well. So there was like representation before the regulators that they have to come up with some policy statements, some policy initiatives which addresses, one, the falling markets, secondly, also the aspects which are operational. So now, when SEBI had come up with the policy initiatives on the request of the market participants, and also the various stock exchanges, so these policy initiatives were basically aimed to achieve mainly two objectives. One was to ensure the business continuity of the market participants and the issuer companies by providing them relaxations for disclosures and the various compliances that they have to do with SEBI. And secondly, they had to create an environment for the companies to raise funds. So post the lockdown, the companies would open and they would require funds for their operations to run because they would be facing this working capital shortage, or they would require some additional funds for them to function. So this was very, very important for the regulator to create a regulatory environment so that the firms are easily able to access the funds. But side by side, it had also to ensure that while achieving the above two objectives of ensuring market continuity and providing relaxations, and also to ensure that the funds are easily available, it had also to ensure that the governance standards are not lowered, that the market integrity is not compromised. So SEBI had to, it had a kind of a choice between the devil and the deep sea. So you had to look at both the aspects. One was in the interest of the market, and secondly, you had also to protect the governance standards and the integrity of the market. Now, SEBI has prescribed timelines for the market intermediaries to adhere. So SEBI registers the market intermediaries, it registers the brokers, sub-brokers, the merchant bankers, and the host of other intermediaries. Now, these intermediaries, when they are registered, they also have to from time to time file their periodical reports to SEBI. So, if there is any let up in filing of such information, then SEBI views it, very sternly, and some regulatory action or enforcement action is imposed. Now, since already the firms were suffering from the COVID-19 related problems, so any kind of stern action by SEBI would have further compounded their problems. So SEBI took a lenient view and it extended the timelines for the regulatory compliances. So the mutual funds, venture capital funds, alternate investment funds, real estate investment trusts, infrastructure investment trusts, RTAs, stockbrokers, depository participants. So whatever information that they were filing before SEBI, they were given extensions up to June 30. Later on, these extensions were also extended. Like these relaxations were extended up in some cases up to August 31, and in a few cases up to September 30. So the timelines for reports and disclosures, so they have to submit reports like quarterly report, then beneficiary owner grievances, half-yearly internal audit reports of the depository participants, half-yearly unaudited financial results of mutual funds, reports of commissions paid by the mutual funds to the distributors, reports on status of clients, funds and securities, then daily margin trading reports by the brokers, regulatory filings, then compliances for the alternate investment funds, venture capital funds, REITs and InvITs. So these were all extended by a month or two. And the relaxations in timelines were also given to the depository participants for conducting their annual system audit and for effecting the transmission of securities and for addressing the requests of the investors to open or to close their demat accounts and to process the KYC applications and uploading of KYC forms. So in all these aspects, some extensions were given to the market participants. So the other form of extensions which were given was for the listed firms. So previously I dealt with the market participants, then there are listed firms. Now these listed firms also have to adhere to certain compliances. So once they list, they are governed by SEBI listing and other obligations regulations. So we have LODR regulations. We call those regulations as LODR regulations. So SEBI gave relaxation and timelines to the top 100 listed companies to conduct their AGMs by September 30, 2020. So as per the MCA provisions and as per the LODR provisions, the companies have to conduct their AGMs within 5 months of the closure of the financial year. So they had to do it by, so 5 months would mean say by August 31. So this was extended by 1 month up to September 30, 2020. They have to conduct their AGMs. They can do virtual AGMs. They can conduct the AGMs, virtually, and they can ask the investors to. There's a provision of e-voting. They can ask the investors to vote on the various proposals through e-voting facility, which SEBI has already put in place. In addition to that, the board of the companies, as we all know, functions through the various committees. So you have the risk committee, you have the nominations committee, you have the other committees of the board. So they have to meet once a year. So extension was given to these committees to have their meeting. In addition to that, the listed companies also have to submit reports like the certificate of share transfer. Then they have to submit quarterly reports for the investor grievances. So whatever grievances the investors may have with the company for, say, non-payment of dividend or for some transfer of shares. Though, we have very few companies which still have left with the physical shares. Mostly we have the, demat shares, but still a few companies are having physical shares. So there was this extension given, and then secretarial compliance reports, corporate governance reports, all these were given. In these respects, there was an extension given to the companies. In addition to that, the companies also have to disclose their shareholding pattern on a quarterly manner on the stock exchange website. So there was this extension given for disclosure of shareholding pattern as well. One requirement is to have a maximum gap of 120 days between two board meetings. So this was also, this requirement was also relaxed. Now, one important, so till now we've been speaking about the relaxation in terms of compliances and the disclosures, the compliances that are to be met by the listed companies. And before that, I discussed about the compliances and the disclosures that were to be done by the market intermediaries. Now we come to the second aspect, the second objective with which SEBI functioned, or rather lay down the policy initiatives post the COVID-19 scenario. So as per SEBI regulations, there are certain, provisions which the companies have to fulfill. So we have a set of regulation called as Issuance of Capital and Disclosure Regulations, ICDR 2018. So as per that regulations, they have certain eligibility norms. So the companies have to fulfill those eligibility norms before they can raise funds from the market. Now, SEBI had given some relaxations in those eligibility forms so that the firms can have quick access to the funds. So as per the SEBI regulations, the companies which have bought back securities, as per the SEBI buyback regulations, they cannot raise funds from the market for 1 year. The reason is very, very simple. If you have returned the funds to the investors in past 1 year and you found no use of those funds, so there should be some cooling off period for 1 year. It cannot that suddenly some requirement has arisen and the company is raising funds. So there's this kind of a cooling off period of 1 year, and after 1 year, the company can come back and to the market and raise funds. Now, because of this COVID-19 situation, and since it was felt that the firms may require funds immediately after the lockdown is lifted, so this aspect of regulation was relaxed, and from 1 year, the period was reduced to 6 months. Now, the companies which have bought back securities from the investors 6 months ago, if they feel like they have to raise funds through the fast track issue or through the rights issue, they could easily approach the regulator. They could file their offer document and raise funds. Now, the other aspect is that we have, as I spoke about this regulation, Issuance of Capital and Disclosure Regulations. This is 2018. I'm sorry, I put 2008. This was recently amended. Now it is the new set of regulations that's coming. This is 2018. So this is a provision of fast track issues, and this provides firms, the eligible firms, quick access to funds, and the criteria for bringing fast track issues has also been relaxed. Now, the companies which are having a market capitalization of public shareholding about say 100 crores, they can easily access the funds through the fast track issues. Previously, the eligibility criteria was 250 crores. Now it has been reduced to 100 crores. In addition to that, the companies which have listed on stock exchanges for 3 years and have complied with the LODR, which is the listing and other disclosure regulations for last 3 years, they were eligible under the fast track scheme. Now SEBI has reduced that time from 3 years to 18 months. So any company which had listed on the stock exchange for the first time in during the last 18 months and has been complying with the LODR regulations, they are eligible to bring in on the fast track issues and raise funds. Now, one aspect about raising funds is that the companies had to achieve a minimum subscription of 90%. If they were unable to achieve this minimum subscription of 90%, they had to refund the investors back. But now this minimum subscription has been reduced to 75%. So from the earlier 90%, it's been reduced to 75%. And the SEBI ICDR regulations become operational if the aggregate value of securities is 25 crores. Earlier, this value was now it has it has been increased to 25 crore. Earlier, this value was 10 crores. So there is a relaxation here as well. So anyone who is raising about 10 crore, the SEBI ICDR regulations will. So SEBI has also, been taking some punitive action against the entities which have indulged in manipulation, or SEBI has issued show cause notice to such entities. At times, these entities also avail the consent and settlement mechanism. So under the consent and settlement mechanism, at times the companies they approach there is a high-powered committee which has been established to look at the consent and settlement mechanism. They approach the regulator, and they want to settle the case. And in that case, the regulator imposes certain kind of monetary, I should not say penalty, but some kind of monetary burden is imposed on them, and the entities pay that amount, and this amount goes to the Consolidated Fund of India, and the case is considered as settled. So no further investigation takes place. So such cases, the companies were ineligible to come to the fast track issue. They were not eligible to bring the fast track issues. But now SEBI has allowed the companies which have in past 3 years, which have been issued show cause notice or have settled the cases under the consent mechanism, they can also bring the fast track issues. SEBI has also diluted the provisions for the companies to which the show cause has been issued by SEBI, and this show cause has been issued under the adjudication proceedings. So under the adjudication proceedings, we normally levy the monetary penalty, and in addition to that, if they have fulfilled the settlement orders, so whatever settlement orders were issued in the consent mechanism, if they fulfill those orders, then they can come and access the markets through the fast track issues. So at times, what happens is that there are some audit qualifications while the auditors, are looking at the financial books of the companies. So the firms have to make the disclosures in the offer letter about these audit qualifications. And the firms which have been suspended from trading during preceding 3 years, they have been granted a relaxation to bring fast track issues. And this period has been reduced from 3 years to 18 months. Now, RBI had allowed a moratorium on loan servicing. We are all aware about that. That there was a deferment on repayment of term loans. SEBI, in line with that, allowed the registered credit rating agencies to apply differential treatment and to make a distinction whether the non-payment or delay of interest or principal is due to lockdown conditions. So if the firm or the company was unable to pay the the interest on the fixed income securities, on the fixed income securities, so they were given this this benefit by the credit rating agencies if it was due to the lockdown situation, and so these were not to be classified as defaults. Then there are valuation agencies which are providing the reference price for the thinly traded securities for the securities held by mutual funds. Now, these valuation agencies were also given a kind of a guideline by SEBI that they could also use the same principle of making a distinction whether this non-payment or delay in principal or interest for the fixed income is held by the mutual funds. If there was this delay or some non-payment, so it could be viewed as not a case of default, and it will not be classified as a default. They could always apply this differential treatment to such cases. So with that, I am through with my presentation. Essentially, there was this mandate on SEBI to respond to this situation. Mandate was basically twofold. One was to ensure the business continuity, and second one was to ensure that the funds have access to the firms have the access to the funds when they require. And these were the few steps that SEBI has taken. These are not the whole steps that I mentioned over here. Few steps which I've presented for you. That I hand it over to Professor Nanda.
Yeah. Thank you so much, sir, for this beautiful deliberation. Now, I would like to request Dr. Lathachari ma'am to address the participants. Ma'am, please.
Thank you very much, Professor. I'll first share my presentation and then start off. Can you see my screen, please? Is my PPT visible?
No, ma'am, I'm checking.
No. Not visible.
Not visible.
How about now?
Yes, ma'am.
I got it.
It is coming.
Can you see my PowerPoint, please?
Yes, ma'am.
Thank you. Yeah, so my colleague Professor Vishal Shukla has taken through very, very nicely and beautifully how SEBI as a regulator has, on the one hand, protected the markets and the investors in a highly volatile period, and then on the other hand, how they have facilitated the capital market funds to keep flowing. They have not only facilitated and seen that the day-to-day trading activities go on smoothly. On the other hand, they have tried to keep the investment raising process, the reporting and regulatory process probably freed up the different things that were actually causing a hazard to people who wanted to raise funds, and they have kept the markets going. So wonderful presentation by my colleague Professor Vishal Shukla. So with that, at the outset, I would also like to thank the management of the university for giving me an opportunity to make this presentation. And then I would like to start off with trade and investment post-COVID scenario. I have attempted to make this presentation more factual, giving you various data and details, and then maybe we will raise some questions based on the data and try to understand about trade and investment in the post-COVID scenario. So that's the way I have designed this presentation. Okay, so let us start off. I'm going to share with you first the how the trade and investment, predominantly I'm going to stick to equity markets. Given the time constraint, we will just go through the equity market segment of the capital markets and understand how the markets have reacted during the COVID scenario, and then deliberate on what are the reasons, how things have moved, good, bad, all the different things. Yeah, so that's what I'm planning. So let us start off with the two major indices, which is provided by the National Stock Exchange, the Nifty index and the Bank Nifty index. Okay, so you can see this graph where I have provided data from January 2020 to August 2020. Okay, so the COVID shutdown in India happened maybe somewhere here. The lockdown announcement happened somewhere here. Yeah, so somewhere in the middle of this fall that you can see, maybe not so much in the middle, somewhere in the center, somewhere here, is what the COVID lockdown announcement in India happened. So as of 31st January, you can see that the blue line is the Nifty index, which is this blue line. Okay, and then the red line is the Nifty Bank Index. Nifty Index is the index of top 50 companies listed in the country, and the bank index actually covers the PSU and the private banks listed, and the bank index covers broadly the banking sector. We can actually say that the banking sector is captured or reflected in the bank index. So let us start with looking at these two major indices, which to understand what happened in the capital markets. Okay, so the index generally captures the events and the news related to the economy, be it political, be it economic, everything is reflected in the index in an efficient market. So therefore, let us start with the index and see how the index has behaved. We can see that this Nifty index, which is the blue line, was somewhere around 12,000 in January. Okay, so what happened is, with the news of this pandemic coming in, it started sloping somewhat slightly up to March, and then in March there was a steep fall. Like Vishalji was saying, 2 times the market-wide circuit breaker got triggered in this month of March at the 10% level. 10% plus 10% means directly 20% down in the month of March. So it was probably thinking that maybe nothing will happen to India, we are safe. So we are not seeing a huge slide somewhere in the month of February. It's just trying to hold on. But in the month of March, there is something like a breakdown. No, we are also in trouble, right? So you can see that happening in the month of March here, and it has fallen steeply, and 2 times the market-wide circuit breaker got triggered at the 10% level, and the markets fell to somewhere around I will say somewhere around less than 8,000 levels. Okay, so this is the fall which happened, and post that, the market started moving up, with the government actually announcing a lot of support measures, both on the monetary policy front and on the fiscal front. So various things, relaxations were announced, starting with the regulatory relaxations. So with these relaxations getting announced, I think the market started making an up move sometime after the end of March. And then you can see that they were flat in the month of May, and then now they have actually moved up, and they are close to the 12,000 levels, which is around 11,300. I think somewhere in the morning they were somewhere close to 11,500 today. And so we are about 600, 700 points less than the pre-COVID levels as of now, with respect to the Nifty 50 index, which is an index of 50 top companies in the country. Which means, what is the story Nifty 50 is trying to tell us? It is telling us that I got affected by COVID-19. I corrected close to something like 30%, to 12,000 to something less than 8,000 levels. And then later on, with the stimulus and other positive news flowing into the market, with the positive expectation, the Nifty started going up again, and we are somewhere near the pre-COVID levels, maybe some 700 points away from the pre-COVID levels. Now let's look at the Bank Nifty. Bank Nifty is capturing the banking and the financial services sector. Okay, so we can see that this Bank Nifty is this brown line. The brown line is Bank Nifty. It was above Nifty as of January, but then in March, it actually cut across Nifty and fell far more than what Nifty fell. And coming to the recovery part, we can see that still it was more than 30,000. We have plotted Bank Nifty on the secondary axis. Okay, you can see that it was more than 30,000. It fell far below, less than 20,000. And now it is still not yet recovered close to where it was in the pre-COVID levels. Which means, what is the story Bank Nifty is now telling us? It is telling us that, hey there, I fell a lot, but then I'm still not as good as the pre-COVID levels. I'm still having some problems. I have probably not recovered completely. And this difference in Nifty not going back to pre-COVID levels is also somewhere attributed to banking stocks, which are part of the top 50 stocks, not really moving up to the extent required. Some of the banking and the NBFC stocks. Okay. So this is the story about what Nifty and Bank Nifty is telling us as far as COVID impact is concerned. Now, having said, tracked these major indices, the next question which comes to our mind is, okay, Nifty acted like this, Bank Nifty acted like this, but what happened to the other sectors? Okay, were they doing well or are they doing badly? So to do this tracking, I'm going to take you through some of the sectoral indices and we will see how they acted. Okay, see, now we start with the pharma index. This is an index of the large pharma companies listed and operating in the country. What we can again see is this is one place where we would all have loved to be if we had known it, right? So you can see that this has not corrected much, okay? And post-COVID, it has just moved far beyond where it was. So it was at 8,000. Now this pharma index is somewhere near 12,000. So this is one sector which was not impacted by COVID at all. It just maybe corrected slightly here in the month of March, like what shall I say, to give company to the other sectors, right? So it corrected a little and now it has completely gone upstream after the March and has gone far beyond the pre-COVID levels wherever it was. This was also mentioned by Vishalji in his talk. Okay, so next, okay, pharma did well, we all know, yes, because that's the sector which has actually taken the limelight in this COVID problem. So let us look at what happened to IT, right? IT, unlike pharma, went through a sharper correction. It fell from 16,000 to somewhere near 12,500. But IT also has actually resumed and gone up. It is somewhere near 18,000 now. So it was 16,000. It has gone well above the pre-COVID levels as of now. Okay, so both pharma and IT have done very well. Probably these were two areas where we should have taken an investment if we wanted to actually make some profits. Okay. Now let's look at the FMCG. Wow, look at that. See, FMCG actually corrected from, what is FMCG? Fast moving consumer goods. The Britannias, the Nestle, the Levers are all here in your FMCG basket. Okay, the ITC, they are all there in this FMCG basket. Okay, so what did this FMCG do? Before COVID, it was somewhere near the close to 31,000 levels. Okay, look at that. Wow, lockdown. Wow, lockdown again. So the FMCG just fell like anything. But then at hindsight, if we see, a lot of learning comes when we look at data at hindsight and then try to understand what went right and what went wrong. And that is the purpose behind sharing this data with all of you and making the presentation more factual. Okay, see, what can I say at hindsight? See, the FMCGs are the Britannias, the Nestles, the ITC. ITC is also into making biscuits and your atta and other things, daily needs. Of course, they have a segment of cigarettes, but they are also into these areas, right? So these are the companies which are there in the FMCG. Do you think that if there is a lockdown, I'm going to stop consuming these goods? Ideally, I would buy all this more and store them because there is going to be a lockdown. So do you think this basket should have fallen like this the way it has fallen? Actually, no, isn't it? See, you can see a V here. It's just a very sharp recovery. When people realized that, oh God, these companies have fallen and I can't live without my atta and my bread, right? and my milk, right? So what has happened to the FMCG? It is a complete V. It has just gone up skyrocketing, and after that it has crossed the 31,000 and gone up further. So a little bit of what I will say, it's not even finance. It is not even fundamental analysis. It is just commonsensical thinking would have helped us to locate that this fall, maybe you would have ended up investing somewhere near this 29,000 levels itself, but still you would have done well, isn't it? Because if your common sense tells you that my rice atta sales is not going to go down, what you will do is you will start taking positions in the FMCG counters. And even if you had done it somewhere here, you would have still not lost a lot of money. You would have made money within a period of less than 6 months. Now let us look at the media index. So what does the media index have? It has the Z and the other media companies, Sun TV, right? All these media companies. What we can see is the media companies, which we would expect, all just like the banking and the financial services sector, this is one sector that has been working throughout the lockdown, okay? But in spite of the sector working throughout the lockdown, what we can see is it has fallen quite a lot, but then the recovery has not come up to the pre-COVID levels. So here there is a room to see what happened, why it has not recovered. Are the companies really doing well, or is there an opportunity to enter into the media sector even now? What is ailing the media sector is something which you can still go back and see and try to understand. Now let's look at the metal index. What can we see? The metal has fallen substantially and it has recovered also somewhere close to the pre-COVID levels. These are companies like your Hindalco, right? Hindustan Zinc, who are into the metal space, okay? Right, so here what we can see is this index also has recovered up to its pre-COVID levels after falling from more than 2,500, 2,500, etc. Okay, so what can we say? The Nifty has reached close to pre-COVID, but has not crossed the pre-COVID levels. It is still having some distance to reach the pre-COVID. The bank Nifty is still stuck midway through its recovery. It has not completely recovered. But when we look at the pharma and the IT sector, they have done extremely well. The media has not done well. The metal has reached the pre-COVID levels. So broadly, what we can see is the different sectoral indices, except for media and maybe some more, what we have not covered here and there, have actually reached or crossed the pre-COVID levels. So now this is the data and this is the story the data is telling. The next question, fine, I am actually a person who teaches fundamental analysis and valuation. So my mind keeps going back to fundamentals again and again. So the question that actually comes up here is, hey there, what about the fundamentals? The GDP was falling, isn't it? Actually, it was falling even in the pre-COVID times. And then we were saying that no, GDP will now start going up. We have taken fundamental decisions. We have taken decisions at the ground level, which is going to be helping the industry. It is going to reverse the capex cycle and make things happen. All these were the things we were speaking, and the markets continued to hold on in expectation that there will be an economic turnaround. But what actually happened post-January, February, actually we came to understand that this is not going to really happen. We are not going to turn around. We are going to fall further. So what about the fundamentals? And has the GDP started going up? Is the industrial production going up? Is the sales already going up? Are companies really making money? How is it that the markets have already gone up? Is the economy really running and up, right? So this is one question which will come back to our minds if we are doing any fundamental analysis, right? So maybe I'm just pausing to let your minds think What about the fundamentals, right? So what is the news regarding fundamentals? I think I don't want to go into the economic related data because we have less time and maybe I'm running out of time. Okay, right? So I have actually made a graph of what we call as the price to earnings and the price to book value ratio. Okay, just to give a quick and a very fast perspective of what we call as fundamentals. We know that the GDP is not really going up. We know that we are expecting the GDP in the year 2021 to fall, right? We know all these things, but still, why is it that the market is going up? Is it not aligned with fundamentals? Is there something else which is pushing up the markets? These are the different questions that come to our mind. Okay, see here I have put up the ratio of price to earnings and price to book value. The blue line here is the price to earnings ratio, and the brown lines here is the price to book value ratio. What is the price to earnings? The price to earnings is for every 1 rupee of earnings, what is happening to the price. And this price to earnings and price to book value ratio is of the Nifty 50, the broad index of the NSE, which I have put up here. Okay, now what can we see? See, we can see that this price to book value was a little below the price to earnings. Okay, for every 1 rupee of earnings, the price was at this blue line. Okay, and similarly, for every 1 rupee of book value, if you are a commerce graduate, you know that the undistributed profits which a company is making gets added to what? Net worth or book value, isn't it? You know that if a company is making profits, what happens to that profit? It gets added to the book value. The undistributed profit gets added to the book value. So what do we expect? Do we expect share prices to go up after a company announces profits, or do we expect it to go up before? Actually, share prices start moving in expectation of future profits, future earnings, all these different things. Okay, now given that they move up like that, what we can expect is, we can expect the price to book value, that is the profits, to be somewhere little below, and share price to go up ahead of it if we are expecting the companies to do well in future. Okay, so that's typically the way you expect these two things to behave. Okay, having said that, what we can see, they were behaving like that in the period of this August, September. Somewhere in October, November, December, you can see that the price to book value has actually gone ahead of this blue line. Okay, price to earnings. But then come February, it started falling, and you can see, look at how nicely the price to book value also has fallen. So this little bit of excess book value that was there is getting erased here due to earnings and other results coming in. Okay, now what happened? See, there is a huge divergence in this June, July between these two things, which means the profit is not keeping pace with the price. The price has gone up. Okay, but the profits which the companies are making is not keeping pace with the price. So price to book value has actually fallen here, but then the price to earnings has gone up, which means what is it that the market and the investors are expecting? They are expecting that once this lockdown is opened up, companies will start making huge profits. They will all open up. Whatever is the bottled up demand is going to just come out very fast, and the companies will start improving their earnings much faster, like the V that we saw in the FMCG graph. So based on that expectation, we can see that the markets have actually gone up. So the next question, okay, fine, you are saying that they have gone up like that. let us also try to see fundamental analysis means that you will not take confirmation from a single indicator. You will try to go and see from this route, you will see from another route, you will see a third indicator, you will try to combine many things and then try to understand, is it correct or is it more or is it less, these types of things, right? So keeping that in mind, what I thought is, instead of looking within the country, okay, shall we see what's happening across the globe during the same period? Okay, so what I have done is I have decided to peep into what's happening in China, what's happening in US. They all also fell. Did they go up or are they still waiting down below, right? That will give me an idea about what my peers are thinking, right? So what can we see here? I have put the global picture across. We can see from here that China had a double V kind of correction. Actually, this data stops in April. We need to update it to June, July. What I know is China has also come somewhere close to its pre-COVID levels. Japan has come to its pre-COVID levels. This line shows the COVID, the date on which COVID got declared within that country as a problem or as a pandemic, etc. The first COVID case was found, and the country started tracking COVID on the date on which this blue line has been put up. We can see that Singapore markets also fell. South Korean markets fell. The US index just fell very far. But what we know is it has also corrected. All this data on the indices has been collected from the Bloomberg terminals. Okay, so again, the FTSE, the UK index also fell sharply and it has started its recovery in the early April. And what we know is now these markets have also come somewhere close to their pre-COVID levels, which means, okay, it is not just we in India are thinking that our own economy will kickstart and start going up. The rest of the world is also thinking like me, isn't it? Right. Next. Now, having said that, given different analogies with respect to how the market has moved, is it right or wrong, I also need to talk about what opportunities this COVID has thrown up, and also flag off different, what shall I say, concerns which we have on this market before we actually close this presentation. Okay, so according to me, the biggest good thing to happen because of COVID is change. Okay, as human beings, we are all very, very, what shall I say, we just don't like change. If you change my laptop also, many times I find that the keyboard is not the same as my old laptop, and therefore there is some problem. If I change my mobile phone, again, my last mobile was something different, and therefore I will take 2-3 days to get used to change. Small changes also, we as people really don't want to take it in our stride. We would like to keep the status quo and keep it going. Okay, what has COVID done to us? It has actually made us change, and change at a very, very rapid pace. We were all pushed to the corner. Today, if I'm addressing so many of you through webinar, maybe I would not have done this at all if COVID was not there, isn't it? Right? So today, if we are able to adapt ourselves to technology and start thinking in a new way, and if my institution, your institution, all institutions are trying to exchange knowledge, information, facts, everything, the way we are doing using leveraging technology, this would not have happened. Online was there even before. Why did we not do these sessions? Right? We just prefer to meet, isn't it? Right? We didn't do them. So change at every phase, like Vishalji was saying, like your own professor was saying in his introductory speech, has happened, but it has happened at a very, very rapid pace, far beyond what we can foresee. Be it technology or technology adoption, adoption, be it the middle class or be it any segment across the society within this country, be it the student community, be it the teachers, be it the doctors, everybody has adapted to change at a very, very rapid and fast pace. This is one of the biggest things which COVID has done to all of us. Okay. Along with making us adapt to change, it has also thrown a lot of new opportunities to all of us. Technology and technology adoption, right? The digital India, right? So across sectors, you can say hospital, hospitality, whether it is learning and education, everywhere technology has become a key driver. Banking, capital markets, finance, right? Everywhere it has become a key driver. We can see that there is a lot of global economies who are moving away from China for various obvious reasons. The questions which arise is, can we become a manufacturing hub? We have started the Make in India. Probably we can become a manufacturing hub, making use of this opportunity. Pharma and healthcare is getting its due share and attention and budget, which it has not got in the past. New opportunities for startups, logistics, supply chain, research, right? All these different areas are getting a lot of attention. Education, like I told you, online learning, proctored exams, creating new learning experiences. How do you teach a small kid? How do you teach a grown-up adult? Can you make the learning experience very different, new, interesting, right? All these different things are getting spoken about, and different people are trying out new things. So a lot of innovation and research is happening, and there is a thrust for all these different opportunities. So COVID has thrown out a lot of new opportunities at all of us. So the next thing is, the most important thing is, in spite of COVID, both banks and capital markets have worked flawlessly supporting the economy. And what we know from the data is the capital market has already gone up. They have shown the green flag. The capital market has shown the green flag. The capital market is saying, hey there, I trust you. I know that you guys will do well. But is the economy and the fundamentals going to keep up with the expectations of the market? If the economy and the fundamentals fail to keep up with the expectations, if we fail to capitalize on the opportunities that are thrown up by the COVID, then the markets can actually reverse and get back. So what I can now say is, as of now, the markets have gone up, showing the green flag, showing the optimism, recognizing the fact that a lot of opportunities are being thrown up. If we remain idle, if we don't pick up these opportunities, if we don't pull up our socks and run, then I think we are going to lose on these opportunities, and the markets will start reflecting that once the confidence gets lost. So that's what is my opinion about both trade and investment sticking to capital markets. So thank you very much. I hope I was able to make some sense out of the time that was provided to me. And thank you, all of you.
Thank you so much, ma'am, for this wonderful deliberation. And as we are running out of time, so quickly we'll go for a few questions from our participants. And one question is there from Soumyasri Mahanti for Vishal Shukla, sir. However, the government of India bonds, gold sovereign bonds, are they safe and best way to invest for long term in this uncertain pandemic scenario? Please guide. It's for Vishal Shukla, sir.
Being from a regulator, I'll not be able to comment upon any financial product.
Yes,
so if there is any other query, I'll be happy to take it.
I also would like to add, whatever views and thoughts I have presented are thoughts of Dr. Lata Chari, myself. These are not the thoughts of either SEBI or NISM, the institutions, our parent institution and the institution I represent. Okay, so I would like to give a clear disclaimer. The data has been collected from Bloomberg. The thoughts are thoughts and opinion of Latachari. It does not reflect the opinion of either SEBI or NISN. Yeah. So
Yes.
when you talk about investments, you need to express, and if you don't express what you think, it takes you nowhere. So I would like to provide this disclaimer to all the participants who are there. So it is my
Thank
own
you.
thought. Yeah.
Sure, ma'am. Ma'am, one question is there. Can you say that hospital pharma industry had gone through a positive growth, has seen, but impacted badly in terms of operations in this COVID situation?
Sorry, I couldn't catch your question.
Ma'am, so Mesri Mahanta asked, can you say that hospital or pharma industry had gone through a positive growth or seen hike, but impacted badly in terms of operation in this COVID situation? What is your take on this?
Based on the data, they have gone through a positive growth cycle, right? But then based on how the markets have actually taken it up and reflected, but then we need to confirm it with the quarterly results of the different individual firms, pharma firms. I think some of them have thrown up good results, but then others are, see, there are various things like your formulations getting the acceptance of FDA, right? New markets getting opened up for the pharma producing companies for their drugs and formulations. So in expectations of these things, they have gone up. And some news also has come in during the COVID period in terms of licenses getting approved and formulations getting approved, etc. So the pharma sector has gone up in expectation of these things turning into sales and profits in future. And some companies have actually done well. So it will be a mixed basket. We need to wait and watch for the financial results.
Thank you, ma'am. Ma'am, one question is from a student that which sector of the economy are likely to recover fastest, which is the slowest?
I've already shown you the IT sector, the pharma sector have all actually already gone up. Okay, so among the sectors what I showed you, I think you can see that the media has not reached the pre-COVID levels and they have their own other problems, right? So we need to actually, that's the short answer to what has already gone up. The banking sector has not gone up so much. What we can see, the banking and the financial services sector has not gone up, but the sector is having its own concerns starting from NPA to capital adequacy, right? So they have their own concerns. The NBFCs are having their own concerns, the non-banking finance companies. Though the regulators have given a moratorium, what it means to me is, it means I get more time to pay back. Nothing has been written off, isn't it? I'm just going to get more time to pay back. But even if you give me more time to pay back, unless the business picks up, where will I pay back from? So these are the different types of concerns within the banking and the NBFC sector. Yeah.
Sure.
In short.
Yes. And the last question for today's webinar, that one question from Mesri Mahanta, can you relate this topic with startups, Atmanirbhar Bharat initiatives, and entrepreneurs in SME sector? Atmanirbhar Bharat, startups, MSME, entrepreneurship.
What you want? What is the question, please?
Can you relate this topic, trade and investment, with startups, Atmanirbhar Bharat initiatives, entrepreneurship, and MSME sectors? What is your...
Definitely. See, all the monetary and fiscal policy initiatives are aimed at giving a lot of relief to the MSME and the SME sectors. You want to add something, Vishalji?
No, ma'am, please go ahead. I agree with you on that. Mostly we were discussing about the securities market here, but then as you've rightly pointed out, the fiscal responses by the government of India and the package that has been given to the SMEs, as well as the monetary policy of the Reserve Bank of India, they are more directed towards the other sectors. So, but
Yeah, so they're all, yeah, Continue, sir. But
Yeah, but then, we had restricted ourselves mainly to discuss about the securities market. We did not touch upon those aspects during this presentation.
correct.
Yeah.
So no more questions from our participants. Coming to the end of the session, I would like to thank both our panelists, esteemed panelists, Dr. Lathachari and Mr. Vishal Shukla, for this wonderful deliberation on this regulatory framework of SEBI, the provisions of SEBI, the current situations, different fundraising guidelines and conditions imposed by SEBI, and the NSE Sensex and comparison to different countries. And thank you so much, sir and ma'am, for this wonderful deliberation. I would like to thank
Thanks a lot. Thank you.
our president, Vice Chancellor sir and Pro Vice Chancellor ma'am, for giving me this opportunity to conduct a webinar on this topic, trade and investment, the post-COVID scenario. I would also like to thank all the participants for this active participation and cooperation in this webinar through patient learning. And definitely, I think you have learned a lot of things out of this webinar. Please be in touch, and your e-certificates will be provided shortly. And I must inform you that ASBM University is organizing 2 certificate programs, online certificate program, 2-week certificate programs. One is for finance, second one is marketing. Finance will be starting the 28th of August, and marketing will be starting 3rd of September. So I'm just requesting all the participants, if you are from those background, you can register as soon as possible, and please be in touch. Please visit asbm.ac.in. Thank you so much. Have a good day. Thank you so much. Thank you, ma'am. Thank you, sir.
Thanks a lot. Thank you.